Hey there. So we're up to class 16 for Monday, Wednesday, Friday classes, and this is 12A if you're a Tuesday, Thursday person. So Tuesday, Thursday person, you will still have to do some more video watching after this one. But that's okay, you have fewer classes, so it kind of works out even somehow, I think. So we're moving on with merchandising operations, which means retail stores. And up to this point we've learned the accounting cycle, and really that's the basis for everything we're going to do for the rest of the class. So all we'll be doing from now on really is just adding little portions here and there. For example, we'll add some new calculations for a store that's a retailer. So we'll add things like inventory and how to calculate discounts and things like that that go along with inventory. So really, you know the basics, you know the financial statements. Now we're just adding a little bit of information about inventory and how to restyle the financial statements to include inventory. Just adding a little bit. But you already know the basics, so that's great. So let's start talking about merchandising operations. All right. A merchandiser is a business that sells merchandise or goods to customers. The merchandise that a business sells to customers is called merchandise inventory. A wholesaler is a type of merchandiser that buys goods from manufacturers and then sells them to retailers. A retailer is a type of merchandiser that buys merchandise either from a manufacturer or a wholesaler and then sells those goods to consumers. So most of us probably don't ever deal with wholesalers because we're customers. We go to H-E-B or Walmart or Target and we buy stuff at the retailer. Now those retailers, they have to get their merchandise inventory from someplace. So you know, Walmart might purchase Tide and other soaps from Procter & Gamble's, right? So they're wholesaling those products to Walmart. So this is probably one thing that you need to make sure you keep distinct, is that when you're doing accounting for a company that's a merchandiser, right, especially a retailer, right, who's buying from a place and then turning around and selling it someplace, is that when the company buys the inventory, that's called a purchase, right? So then when they turn around and sell it to a customer, that's called a sale. So don't get confused, because a lot of these things happen on both sides of the cycle. You have to purchase it and then sell it. So there's going to be things like purchase discounts and also sales discounts. So keep in mind, purchase is when the retailer purchases the inventory from the wholesaler and then they turn around and sell it to the customer. That's a sale. All right, so keep that in your brain. The operating cycle. The operating cycle has three main steps. A company purchases inventory from a vendor. The company sells the inventory to a customer, and the company collects cash from customers. A vendor is an individual or a business from whom a company purchases goods. So remember, a purchase from a vendor, a sale to a customer. So in your book, on page 247, it's Exhibit 5-1, and it shows this cycle. Right? A merchandiser purchases inventory, they sell it to the customer, and they get an accounts receivable if they don't immediately sell it for cash, and then the cash gets paid. And then they buy some more inventory, they sell it, right? So purchase, sale, collect cash. Purchase, sale, collect cash. A merchandiser purchases inventory and sells the inventory to customers in exchange for cash. So, because the operating cycle of a merchandiser is different from that of a service company, the financial statements differ. On the income statement of a merchandising company, reports revenues using an account called sales revenue rather than the account service revenue. A merchandiser also reports the cost of merchandise inventory that has been sold to customers or costs of goods sold. COGS. So you'll hear this called COGS. The cost of goods sold is the cost of merchandise inventory that the business has sold to customers. Because COGS is usually a merchandiser's main expense, an intermediary calculation, gross profit, is determined before net income is calculated. Gross profit is the excess of net sales revenue over cost of goods sold. So gross profit is sales revenue minus cost of goods sold, right? So we have to calculate gross profit first. Then we take out the rest of the expenses and get net income. You'll see this in a sec. Operating expenses are expenses other than costs of goods sold that are incurred in the entity's major ongoing operations. So things that aren't paying for the inventory is all the rest of the expenses. So if you look at this example, on the left you'll see a service company income statement. So you can imagine a doctor provides medical services, you have service revenue, and then your expenses. And that's kind of what we've been doing up till now, which is fine. There's nothing wrong with that. You can still do that for a service company. However, if you have a merchandiser, it's super important to keep track of cost of goods sold. I mean, that's like the main expense of the company. So people who read the financial statements want to know, okay, great, I'm glad you're running your business and net income is very good, but the whole point is to sell stuff. So what are you paying for that stuff and what's your gross margin, right? So you report sales revenue minus cost of goods sold equals gross profit. Then you take out everything that's not the inventory expense. So basically, we've just added two lines, right? You still have revenue at the top. Top line is revenue, then cost of goods sold, then gross profit. But we do this little intermediary calculation, sales revenue minus cost of goods sold equals gross profit, because that's really important to people. If it's a store, that's the most important thing, right? These other things you can maybe monkey with and make them higher or lower, but if you're not running the store part efficiently, getting good prices for your products, then that's going to be a problem. I think I need to still read this part. The financial statements of a merchandising company also look somewhat different from what we have seen so far. The most notable difference is that the income statement for a merchandising company includes line items for cost of goods sold and gross profit. So there you go. So the income statement, we've added two lines. That's not that big of a deal, right? You know the basics, add these two lines. Cost of goods sold, gross profit. So what about the balance sheet? Seems like that would probably change too. Slightly. So let's look at just the asset section, because the liabilities and stockholders' equity don't change. If it's a merchandise, doesn't matter. Those are the same. But assets change a little bit, right? So we have current assets, and if there's any other assets, they would be in the long-term or the plant assets. This is just the current asset section. And if you look at the merchandising side, you'll see that we now have merchandise inventory. The balance sheet shows a new asset account called merchandise inventory. Merchandise inventory is a current asset since it is expected to be sold within the operating cycle. So remember, anything that's going to be converted to cash or used up within a year or the operating cycle is a current asset. And so merchandise we'd hope to sell within the year or so, that's a current asset. So if we've added this idea of inventory and therefore the cost of it, cost of goods sold, we got to start keeping special track of that, right? Because you can imagine inventory is the most important asset at a store probably. And we got to track it really well, because you certainly don't want your inventory disappearing. So there's two ways to do this. One is periodic, one is perpetual. In this class, we're only going to learn perpetual. All right, so we're going to mention periodic, so you'll have heard of it. A periodic inventory system is an inventory system that requires businesses to obtain a physical count of inventory to determine quantities on hand. That's just what it sounds like. You go in the warehouse and count everything. That's how you do a periodic inventory. The periodic inventory system is most appropriate for inexpensive inventory that is sold by small shops that do not have optical scan or point of sale capability. We will not use periodic inventory in this course. A perpetual inventory system is an inventory system that keeps a running, computerized record of merchandise inventory. That's what we're going to learn, because let's face it, that's how it works. Ever go to the store, you hear them run your item across the scanner and it goes beep. You recognize it as racking up the sale, right? You know you're going to have to pay for that, but it's also taking it out of inventory. It's perpetually keeping the inventory. And that's what most places do, so that's what we're going to learn. So let's talk about those purchases first. Now remember, I said for a retailer, there are two things going on. You're purchasing from vendors and you're selling to customers. So before you can sell anything, of course you have to get it, right? So let's talk about ordering stuff first that we're going to turn around and sell later. So we call that a purchase, when you purchase from a vendor. So when you purchase from a vendor, you'll get an invoice. And so this example is on page 251. It's Exhibit 5-3. And it's an invoice. It's what you get along with your stuff. So sometimes you might go pick it up. You can imagine in Corpus there's some big warehouses, and you could go to the warehouse in Corpus and pick up your stock from the vendor there. And you would get, maybe you'd write a check to them and you'd pay them right then and there. And you'd get this invoice, or maybe you would order it from them and this merchandise would come and you would get this in the mail and it would tell you, okay, I need to pay this bill. So this is basically the bill. Southwest Electronics has sold 100 tablets to SmartTouch Learning. The terms are $3.15 net 30. So that's the discount. We're going to talk about that later, but this company, Southwest Electronics, is telling SmartTouch, hey, we would love to get you to pay us the cash sooner rather than later. So if you pay it within 15 days, we'll give you a 3% discount. That's what 315 means. 3% discount within 15 days. You might see 210, 2% discount within 10 days, right? So that's all that means. Then net 30 means, well, you have to pay it all within 30 days. All right, so they've ordered 100, that's $35,000 worth of stuff. All right. So this invoice shows SmartTouch Learning acquired $35,000 of inventory on June 3, 2017. Ignore those purchase terms for now. The merchandise inventory account is an asset. So this becomes merchandise, right, to SmartTouch. They've purchased these tablets that they're going to turn around and resell. So that's their merchandise inventory right there, $35,000. So merchandise inventory we know is a current asset. It's an asset, and you increase assets with a debit, right? So how would that look like? Well, merchandise inventory, $35,000 debit. Cash, assuming you pay cash for it, cash, $35,000. Credit. On June 3rd, SmartTouch Learning will record the purchase by debiting merchandise inventory. So there you go. We've increased one asset, merchandise inventory, and decreased another asset, cash. We don't always pay cash for everything. Sometimes we buy stuff on account. Still works the same way. You're either paying cash or you get an accounts payable if you don't. So if the transaction is on account, then SmartTouch Learning will record a credit to accounts payable for $35,000. At this point, we have not accounted for the purchase discount terms. If SmartTouch Learning takes advantage of the discount, we will adjust the accounts payable account appropriately at the time. So remember, we did not pay cash, but they offered us that discount. So now we have to think, okay, what happens with that discount? Well, we haven't really paid anything yet, so we put it on the books at the full price, right? Merchandise inventory, debit, $35, because we got that asset in, and then accounts payable, a liability increases with the credit, and then we've increased that. So let's imagine that now we're going to pay for that. right? So we got that $35,000 worth of stuff in. We're going to pay our account payable. So if Smart Touch Learning pays on June 15th, which is within the discount period, we have to do an entry that accommodates that discount. So recall that we earlier recognized the vendor offered Smart Touch Learning sales terms of $315 net 30 days. According to the sales terms, $315 net 30 days. Smart Touch Learning will receive a 3% discount if it pays within 15 days of the invoice date, which is June 3, 2017. The purchaser's discount is from the purchase discount is from the purchaser's perspective. A purchase discount is a discount that businesses offer to purchasers as an incentive for early payment. The payment terms of the purchase or sale are stated on the invoice. All right, so here is where we make the payment minus that discount. All right, so think about this. We owed $35,000, but they said, well, we'll give you a discount if you go ahead and pay us early. So we say, well, yeah, that's a lot. That turned out to be $1,050. 3% of $35,000 is $1,050. So we're going to take advantage of that. So how do we do that? Well, accounts payable is what we owed them, right? We owed them $35,000. So we're going to zero that out because we no longer owe them anything, right? We're paying them off. So we're paying them off, so we put $35,000 debit, which reduces the liability. Then we put cash, $33,950, because that's the amount of cash we're actually paying. Remember, we're only paying 97%, right? We take that 3% off. So the cash we actually pay is $33,950. But wait, our debits don't equal our credits, right? $35,000, $33,950. So what we do is we take that extra $1,050 out of the merchandise inventory, right? Because remember, we got that went in the inventory at first, so we got to take it out because it really wasn't part of the inventory anymore. So accounts payable, cash, and merchandise inventory equal our one debit for $35 and our two credits that total $35. All right. All right. So what happens next? Well, let's suppose we return something, right? Could you imagine the possibility where maybe those tablets arrived and a couple of them got broken in transit, or maybe some of them weren't the right kind of tablets, right? You ordered some special kind of tablet and they sent you some plain ones that weren't really what you wanted, something like that. So that's a situation that can happen, so we need to account for that, right? Purchase returns are a situation in which sellers allow purchasers to return merchandise that is defective, damaged, or otherwise unsuitable. A purchase allowance is an amount granted to the purchaser as an incentive to keep goods that are not as ordered. All right? So purchase returns means you return it. Purchase allowance means, all right, you know what, don't even bother to ship those back, just keep them and we'll offer you a discount off of that, something like that, an allowance. We'll knock that off your bill. All right? So purchase return, a purchase allowance could happen. And they do certainly happen. So what would that look like? Well, in this example, we're imagining that 20 tablets are being returned, right? Maybe they're defective or something like that. So assume Smart Touch Learning returned $7,000 worth of the purchase. So on June 4, Smart Touch Learning returned $7,000 of the inventory to the vendor. This has the effect of reducing the outstanding account payable from 35 to 28. So to recognize that, we take that $7,000 off. So we no longer owe that because we returned it, so we don't owe it. So we debit accounts payable and we credit merchandise inventory because those are no longer in the inventory, right? So we just take those off. It's just the opposite transaction of putting them on. We're returning them. We're taking them out of there. All right. Next question. So you can certainly post allowances. That's just the opposite of when you buy it, when you purchase. All right, so transportation. Right, so those tablets came, let's say, by a UPS truck, right? They got shipped from the vendor to the purchaser, which was Smart Touch Learning. So who pays for that? Did Smart Touch Learning pay for the shipping, or did the vendor pay for the shipping? And who owns the stuff while it's in the truck, right? Well, we account for that by using this term called free on board. So let's learn about that. Either the buyer or the seller must pay the transportation costs of shipping merchandise inventory. The purchase agreement specifies free on board terms, FOB, free on board terms, to determine when title to the goods transfers to the purchaser and who pays the freight. Right? So this little picture kind of gives you an idea. Well, either when we put it on the truck at the seller, it becomes the buyer's, right? So therefore the buyer pays the freight, or, right, so that's FOB shipping point, or it doesn't really belong to the buyer until it gets there. So the destination, and that's called FOB destination, and the seller owns it and pays for it. FOB shipping point is a situation in which the buyer takes ownership or title of the goods after the goods leave seller's place of business, the shipping point, and the buyer typically pays the freight. Right? So as soon as it gets put on the truck, it becomes the buyer, so they're paying for it. FOB destination is a situation in which the buyer takes ownership of the goods at the delivery destination point and the seller pays the freight, right? So you can see FOB destination, it's getting on the truck and it stays belonging to the seller until it gets to the buyer, so they're paying for everything on the way because it's still theirs, right? So FOB destination means it belongs to the buyer when it gets there. FOB shipping, it belongs to the buyer from the shipping. Freight in. So obviously we are going to track the shipping costs using an account somehow, keep track of it, right? So if it's shipping point, the purchaser is paying for it. FOB shipping point means the buyer, the purchaser, is paying for that shipping cost, and it becomes part of the merchandise cost. So everything all the costs to get that merchandise into the warehouse, that's part of your merchandise inventory. So that's all that's happening here is Smart Touch Learning is paying for the shipping of the tablets. They're buying it, they're the buyer, it was FOB shipping point, so they're paying it for the freight charge. Assumes Smart Touch Learning pays a $60 freight charge related to the June 3 purchase. Smart Touch Learning should record a debit to merchandise inventory and a credit to cash. It just becomes part of the merchandise inventory, even though it's not an actual thing you've purchased, it's just the shipping costs. When merchandisers are required to pay for shipping costs, those costs are classified as either freight in or freight out. Freight in is the transportation cost to ship into the warehouse, right? So that's why this is freight in. These tablets are coming in, so it's freight in. Freight in is transportation cost to ship goods into the purchaser's warehouse. Therefore, it is freight on purchased goods. Freight out is the transportation cost to ship goods out of the seller's warehouse. Therefore, it is freight on goods sold to a company, to a customer. All right, freight in with a discount. Oh my goodness, now we're starting to combine things. It's okay. Remember, we got discounts handled. We got freight in handled. We can certainly handle a discount. Discounts are computed only on the merchandise purchased from the seller. Discounts are not computed on the transportation cost because there is no discount on freight, right? So the $35,000 discount that we did stands. We don't need to change it. We don't additionally discount the freight. Under FOB shipping point, The seller sometimes prepays the transportation cost as a convenient and lists this cost on the invoice. If Smart Touch Learning pays within the discount period, the discount will be computed only on the merchandise cost, not the total invoice. So remember, break out freight charges. No discount on freight charges. That's all you have to remember. Just take them out when you calculate a discount. So we have to figure out the total cost of the inventory purchase, right? Because some things are going on. We've got the cost of merchandise, we've got freight, we've got discount, we've got some returns and allowances. So what's our actual inventory cost? Because remember, we have to be able to figure out that cost of goods sold. So how much is really our inventory? What's going on here? The net cost of merchandise inventory includes the purchase cost of the inventory, less purchase returns and allowances, less purchase discounts, plus freight in. Knowing the net cost of inventory allows a business to determine the actual cost of the merchandise purchased. So this is super important. Remember, we want to know the cost of that. So what we paid for that purchase cost minus returns minus discounts plus freight in, right? So what it actually costs you to get that stuff there, right, is what we're doing. So let's talk about freight in within the discount period. So here's the example of freight in within the discount period. No, wait. We already talked about that, right? Sorry, I'm going the wrong way. One last thing. So sorry. Okay, sorry about this. I pressed enter a little bit too much. Just getting all ahead of myself. All right. Oh, so I guess we're done. The calculation of net cost of inventory purchased is determined as follows. Purchase cost of inventory minus purchase returns and allowances, purchase discounts plus freight in equals net cost of inventory purchases. All right. So see you at the next film.